Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. Today we're going to be covering stock options and restricted stock. Now, this is becoming more common form of compensation from companies to offer these option plans of restricted stock. And today we're going to be going over how these different features work, how they vest, the tax ramifications that you have to be aware of, as well as some advanced execution strategies that you could consider as you become vested in these either options or stock, as well as common mistakes we see people make when executing their option strategies. Now, there's a bunch of different types of option and restricted stock. There's incentive stock options, non-qualified, there's restricted stock, RSUs, RSAs. So we're going to kind of touch on each one briefly. And it's good to know the difference between each kind, because even though you might only have, let's say, RSUs right now, it's not uncommon for companies to start with a certain type of option and then progress to different types of options or restricted stock along the way. So it's good to know the differences. So I'll start off talking about ISOs, which are incentive stock options. Now, these types of options, even though you might have a different type of option like a non-qualified restricted stock, it makes sense to listen to this piece because the terms I'm going to use are going to carry over into those other type of options and restricted stock. But ISOs are the ones that have the really preferential tax treatment for the employees if executed correctly. And the best way I can kind of illustrate how they work is to give you an example. So in this example, I work for an employer that in December 2019 grants me 1,000 ISO options that can be exercised at a price of $30. Now, this has a 4-year graded vesting schedule, which means I vest in a piece of those options each year. So let's say it's an even grading. December 2020, I get 250 shares vested, 2021 another 250, and so on. So in December 2020, my first tranche, as it's called, will vest, and I have some decisions I have to make. So let's say at that time, December 20, the current share price is $100, which means my options are in the money because the current price is above the exercise price at the grant date. So I really have 3 things I can do here. I can exercise and sell, I can exercise and hold, or I can actually do nothing. And we're going to go through each one of those 3 items here. So I'll start off with the exercise and sell option. So in the example, your current share price is $100. You subtract out the exercise price of $30, so you have a net amount, or what's called a bargain element, of $70 per share. Now, if I decide to sell all 250 shares, $70 times 250 shares equals $17,500. Now, it's important to note that if you exercise and sell, that full $17,500 is ordinary income to you, which you will pay in the year that you exercise those options. So now I'm going to go over the buy and hold option with ISOs. And this is probably the most beneficial piece of ISO options, that instead of just exercising them or getting vested and paid in ordinary income tax immediately, ISOs, if you exercise them and hold them for more than a 12-month period, that bargaining element or net gain is taxed at long-term capital gains rates, which is usually more beneficial than ordinary income tax rates. But there are 2 important things to consider when you do this buy and hold strategy. The first is, where's the cash coming from to actually process the options exercise? And the second is kind of the hidden tax hit that people find out about later on. So let's address the first one. So one is where you get the cash from. Because in our example, if there was an exercise price of $30 and I'm going to exercise all 250 shares, I got to come up with $7,500 to actually exercise them. So there's 2 ways that people can do this. Some is they bring outside cash of $7,500, so then they can exercise at $30 per share and then exercise and hold the full 250 shares. Or if you don't have cash outside of this kind of options plan, you can just exercise and sell enough ISOs in order to produce enough cash to kind of exercise and hold the remaining ISOs. So an example might be, if I exercise and sell 80 ISOs, if it's worth $100 and it's a $30 exercise price, that should produce about $5,600, and then I can use that amount to exercise and hold the remaining shares and get the preferential tax treatment on those shares that were held more than 12 months. So the one tax element that you have to be very careful of with this strategy is even though you're actually not getting any cash in your hand, you are triggering a tax event, because what the IRS says is of that bargain element, that's $70 between the exercise and the actual current stock price, even though you don't have it in your hand, they make you pay AMT tax, which is a special tax calculation on the bargain element. So at the end of the year, you'll have a tax liability. So if you're doing this, you really have to work closely with your accountant to make sure you have enough cash to pay the tax bill that's going to be due in that year. So the third option with the ISOs is just do nothing. When I vest, I don't sell, I don't exercise and hold, I just do nothing. Like, that's an option. And where that kind of comes up more often is if your shares or options are underwater. So if I'm at a $30 exercise price and the stock current price is $20, my options aren't worth anything. So I just kind of continue to hold them until eventually they become worth something, and then I have to make some decisions. The other reason why people might decide to do nothing is they don't want to trigger a tax event. If for some reason, let's say I have kids in college and I'm getting financial aid, if I do an exercise and hold or an exercise or sell, that's going to show more taxable income in that year, which could impact my financial aid or other elements of my overall financial plan. But by doing nothing, you also have to be aware that a lot of these options have expiration dates, and usually it's 10 years. So from the 10-year date from the date it's granted to you, you have to do something with them, otherwise they expire. So don't miss that expiration date. So now let's flip gears over to the non-qualified stock options. And these are more simple because really there's only two options: exercise and sell, or do nothing and just continue to hold them and exercise and sell at a future date. They don't have the preferential tax treatment like ISOs. So the way it kind of works in operation is, if you're with a publicly traded company, usually they have some brokerage platform, whether it's E-Trade or TD, and basically you log in, you're gonna see your vested options there. You can choose to exercise and sell them. It's all ordinary income tax to you. But what's usually different is a lot of employers do automatically calculate Fed and state taxes that come out of those amounts. So you usually get the net amount after tax, but it still makes sense to check with your accountant because sometimes they accidentally under withhold for Fed or state, so you still potentially could have a tax amount due. So just be careful with that. So now let's talk about restricted stock, RSUs, and RSAs. So RSUs are restricted stock units and RSAs are restricted stock awards. Like, these do operate differently than the stock option side, because restricted stock, it usually has value as long as the company has value. Because remember, with the options, it has to be above a certain exercise price. With the restricted stock, you have the stock, you're just kind of waiting for it to vest. And as long as that company has value in its stock price at the date you vest, it's automatically worth something. So that's why it operates differently. So I'll show you an example of this. So using our December 2019, this company granted me 1,000 restricted stock units that vest over that 4-year period that we already talked about. But this time, when I get to December 2020, whether I want to decide to do something with it or not, that money is going to be taxable to me based on whatever the share price is at that time. It has immediate value. Unlike options where, it had to be above or below the price, or if I didn't exercise it, I could put off the taxes. With restricted stock, you know you're going to have a taxable event when these things vest. So from a tax and operation standpoint, the way these really work is when I hit December 2020 and I vest in my 250 restricted stock units, the company will automatically sell enough shares in order to cover my tax liability, and then I get the net amount of shares in my brokerage account. So I might only see 170 shares in there. And then once I have those 170 shares, I've already paid tax on them, so I can choose to just sell them and take the cash, or I can decide from that point, just like any other stock, I've already paid tax on it. I have those 170 shares. If it continues to accumulate, I get it at long-term capital gains rate, but now it's just from that 170 and above. It's not that bargain element like the ISOs. So what's the difference between restricted stock, RSUs, and restricted stock awards? It really usually depends on the type of company you're working for. So if you're with a publicly traded company, they usually have restricted stock because there's a market readily available for trading. If you're not with a publicly traded company, usually they're doing RSUs because you just can't trade that on an exchange. And then the RSAs, which are the restricted stock awards, we see those more on the startup side. So we see these restricted stock award plans used by startups as a way to compensate employees when the company doesn't have cash yet. And there could be immediate vesting in those options. So as soon as they start working, they're 100% vested. It could have a vesting schedule, or it could trigger upon the sale of a company or when the company goes public. There's a lot of options available within those plans. The other thing we see frequently within these RSA plans is something called an 83B election that can be made. Now, the way this works is if I work for a startup and I just got these RSA options, and really the shares are worth nothing at this point, that 83B election allows me to say, I want to pay ordinary income tax on the value of the company now, which is really zero. So when it gets sold down the road, I get to pay long-term cap gains on the full amount of the gain. If I don't make that election, that full amount of the gain could be taxed as ordinary income, but that 83B election needs to be made within 30 days of the grant in order for it to take effect. Now, that 83B election can be made with RSUs, but you just have to be careful. When you make that election and the stock already has value, you're electing to pay tax on something now that if it's worth less by the time you vest or it becomes worth nothing, you pay tax on something you kind of never had. So just be careful. As always, please feel free to reach out to us at moneysmartboard.com. Thank you.